Welcome to Taking Stock for the week ending 3rd of March 2023, where myself, Tim Lincoln, our head of Stock Doctor Research, Kien, Trinh, stream to all things share market. How are you, Kien?
Tim, kind of relieved that this busy period is coming to an end, but the analysts have still been very proactive. You know, we've seen companies come and gone, you know, especially after such a big period of profitability over the last year. But now it's about being proactive and managing those portfolio risks and also looking for opportunities at the same time.
Yeah, well, hopefully our members have been very proactive as well during this really busy time of year, especially now with so much interesting macroeconomic events going on. We'll cover all on that shortly. But good to see you and welcome to all of our members for this edition of Taking Stock again. But before we get started, just a reminder that all of the information we share today is of a general nature, and we haven't taken into account your personal situation or needs, and therefore should not be construed as personal advice. And all of the information that we share today too is of historical nature, and there should not be relied upon as a guide for future performance. But as you said, Kien, reporting season is now over, and companies delivered mixed results, didn't they, really? The margins are being weighed down by higher costs such as labour and energy prices, and inventory levels remain high while cash flows have softened. And we were expecting that, weren't we? But more on that in a minute also. And also with debt costs on the rise, this is adding further strain, isn't it, Kien, on the financial health of companies?
Yeah, that's right, Tim. I mean, these factors are contributing to this highly uncertain outlook, especially for the year ahead, since only half of companies provided quantitative guidance. And as you said, with interest rate expectations also revised higher over the month, the All Ords Index, it dropped by about 2.5% in February, while the small caps, they fell by much more, by 3.7%. And this environment is making it difficult and challenging for growth investors, especially those exposed to that smaller end of the market. And on the other hand, though, income investors, they've sought the refuge of those large cap defensive stocks. They managed to outperform the market over the month. So, Tim, what is your view for the market ahead and how are the funds positioned?
Yeah, thanks, Kien. It's Matt Schwartz, my senior portfolio manager, and myself, in conjunction with yourself and your team too, Kien. We've certainly got the barometer out there on the market right now, and you know we're fully invested. All of our funds, the Lincoln Australian Income Fund, Lincoln Australian Growth Fund, and our 2 US funds, but one being hedged, one unhedged. You know, normally we're fully invested, but right now, Kien, especially on the bounce, the smaller end of the market and the growth end of the market, quality end of the market that was savaged for so long, really has had a nice bounce in stock price performance since really the start of this financial year. And so we've made the decision to take some money off the table, take some profits off all of our funds because they've done quite well through that period, and sitting around 25 to 30% cash at the moment in a real tactical position and an element of defensiveness, because Kien, and this narrative we've been talking about now for a little while, we believe, Kien, that the real bite from rising interest rates and those inflationary pressures hasn't yet hit the financial statements of listed companies both here and in the US. And we believe, Kien, based on high probability, that we're going to see those earnings revisions and downgrades come through in the next quarterly results in the US and the next annual results here in Australia in June. They should start to flow through over the next few months. So we've taken that real defensive position, and we'll use some of that cash to exploit tactically once we get some of those signals that the market may have corrected in some way. But also during this period of sitting in cash while we wait, we'll look at some products that we can perhaps use to maximize yield in our income fund through fixed interest products and the like, but also with our growth funds, how we can use some products, perhaps leverage off further volatility.
Yeah, that makes a lot of sense. Those fixed interest securities, they are effectively bonds, but issued by companies. So they tend to be a little bit more defensive than traditional equities as well. But very interesting. Active management is so critical in this environment of slower economic growth, Tim. And just this week, Australia's GDP growth rate data came out, and it slowed to about 0.5% in the December quarter. And that compares to 0.7% previously. But what was really interesting about that, Tim, was the fact that household savings ratio, that fell quite sharply to 4.5% versus 7.1% over the quarter. And so with interest rates on the rise, consumers will be less likely to rely on those savings to help cushion the impact to the economy. And only this week, Tim, Harvey Norman was punished after cutting its dividend and reporting a 10% decline in sales for January. So with the rise in working capital, such as higher receivables and inventory you mentioned before, Tim, there is a risk of discounting, which puts further pressure on profits and margins, especially in this space. And this is why we've been quite cautious about the consumer discretionary sectors and have removed some companies like Adairs and also JB Hi-Fi from our portfolios, Tim.
Yeah, interesting, Kien. Very, very interesting indeed. And look, backing on what you've just said and what I'm about to say around financial health, any products that we look at to use tactically in our funds must have, especially if they're bonds or hybrid type products, the number one condition for any stocks that we look at that offer those types of products must be financially healthy. So we're still applying golden rule 1 to any selection there of those particular products. So financial health remains incredibly important, a risk management tool for ourselves and also our Stock Doctor members, of course. Recently, Kien, PointsBet, a corporate bookmaker that is in distressed financial health, fell by more than 10% after the company announced a $178 million loss, which was well below consensus and market expectations. This company has relied on capital raisings to stay afloat for quite a while now, which is really interesting considering the amount of advertising they do around the country is just incredible. While at the same time of all of this, the distressed state of the company and all of the active marketing and at the same time making that huge loss, the CEO continues to receive a very, very generous remuneration package worth around $1.8 million.
I know, Tim, and that's all visible on Stock Doctor. But, within this sector, investors really need to be careful here because there are quite a few financially weak businesses, such as the Lottery Corp and BetMakers Technology, and even the larger cap like Star Entertainment as well. So those looking for exposure in this space could consider some of our star stocks, such as Pokies Machine Maker, Aristocrat Leisure, or even lottery platform Jumbo Interactive. But moving on to some of our star stock highlights for the week now, borderline star growth stock and also global logistics provider and pallet maker Brambles, they positively surprised the market despite being a bellwether for the global economy, which is slowing down. So the reason being is because Brambles upgraded their full year guidance for underlying profit to grow between 15 to 18%. And the reason for that is because they've got such a strong market position, they've been able to pass on these costs to customers, and they've been able to increase their pallet prices by 14%. In addition, also, those retailers, they've been slowly moving away from hoarding those pallets. And the return of these pallets to the company allows them to boost their growth in the next half as well. So although it was a strong result, we are keeping a close eye on one of the key issues, Tim, you mentioned, which is cash flows, which are weaker over this half.
Yeah, I'm sure you'll keep a close eye on that, Kien, but Brambles is certainly a wonderful success story, isn't it? Just on the back of their core business being that pallets business globally. Amazing. But weak cash flows have been an issue this reporting season, Kien, as we mentioned earlier. And unfortunately, we've had to remove some underperformers from our star stock portfolios. Let's start with the list on top of the list, which is a bit of a sensitive one at the moment, isn't it? Which is Baby Bunting. We ceased coverage of Baby Bunting because of the weakening consumer outlook and disappointing profit margins. However, in BBN's first quarter trading update in October, management already indicated that margins were under pressure. So, Kien, and we've had this conversation internally quite a bit, but let's share the outcomes of those conversations with our members. Why didn't we remove baby bunting a few months ago?
Yes, Tim, quite a pertinent question here. But despite the weaker margins, baby bunting sales back then, they were achieving growth of around 3% higher than consensus. But in addition to that, the share price back then also reacted quite strongly. So we believe it was overdone, and this was reflected in the share price moving back above $3 at one stage as well, Tim. But unfortunately, following its February results, the market was spooked by news that their CEO was also planning to resign as well, Tim.
Yeah. And look, Kien, we can't get them all right, can we? And sometimes the indicators are there that it's a really good underlying business. So we hang in there for a while, but we're always looking to constantly improve the timeliness of the ins and outs of our star stock portfolios, aren't we? But fair points on baby bunting. But given the consensus is forecasting a recovery in its earnings in financial year 24 under Golden Rule 3, Kien, do you think it's too late to remove the stock now? Have we been way too reactive?
We had a good discussion within our analyst team around this, Tim, especially given where the share price is trading. But and also the fact that many of these risks are also well known. But we believe the issue we have with baby bunting is that they are still not out of the woods just yet. They managed to reaffirm their profit guidance, but this implies that they will need to achieve around about 77% of their full year profit in the second half. And this is quite a high achievement. And with those ongoing risks around consumer spending, interest rates, and margin pressures, we believe that these figures are quite optimistic. So we prefer to sit on the sidelines for now, given that there is a high chance that they could downgrade these earnings figures later on.
Yeah, look, I really respect why we hung in there with baby bunting. I really do. The numbers stacked up, but after a while, the active risks just become too much, don't they? As articulated clearly in the analyst comments and strategic comments. And because of that, because of what's articulated and what I see under Golden Rule 4 and in the strategic comments, short interest, another very active risk that we closely monitor on baby bunting, has risen abruptly in the last few weeks. But forecasts are projecting an attractive dividend yield of 7.6%, with dividends fully covered by free cash flow. So therefore, we understand from a growth perspective and short interest, but that yield looking so attractive, why have you removed them as a star income stock also?
Tim, we're just trying to look behind those numbers as well. And the company cut its interim dividend by 60%, to around 2.7 cents per share. And this cut really suggests that management are really not confident on the outlook of the business themselves when a company cuts it by this much. And baby bunting, they usually pay a second half dividend of around 20% higher than the first halves. So if we project this forward, the forward gross dividend yield should be closer to around that 3%, not the 7.6% that you suggest, Tim. So there is a significant risk that dividends will be downgraded as well.
Yeah, okay, excellent point. So that's very compelling. So I really get your logic, and I'm sure, or I hope our members do too. But if they've got any further questions, by all means, give the analyst team a call and talk through baby bunting. Okay, so we sit on the sidelines for now, but we may revisit the stock when the active risks start to subside. And during the week, we had to say goodbye to a few other star stocks, which is very normal during reporting season, isn't it, Kien? We said goodbye to Metals X Limited, Perpetual, and MyState. And please refer to our commentary on those stocks for more information.
Yeah, that's right, Tim. There's quite a few heightened risks around some of these stocks. So, and our analysts have tried to explain that clearly in those commentary. But with the reporting season now over, we do have a few star stocks going ex-dividend, especially those star income stocks. And this includes Bendigo and Adelaide Bank on the 6th of March. They are paying quite an attractive yield. Super Retail Group on the 8th of March. They did quite well during the reporting season, especially with challenging conditions as well. So for more information, please visit our corporate calendar.
And now to Under the Microscope, Kien. And this week, we take a look at another very interesting stock on the back of baby Bunting. And it's an existing borderline star growth stock and star income stock, Helia Group, who was previously Gemworth Mortgage Insurance. And the company is a provider of general mortgage insurance, Kien. And it appears to be highly sensitive. That's why it's an interesting stock at the moment. Highly sensitive to a rising interest rate environment and the slowdown in the property market. This is reflected on Stock Doctor with earnings growth highly negative for the next 2 years under Golden Rule 3. Yeah, Kien, you and your team have retained the stock as a star stock, which is fascinating in this environment, as I've just said. So what's your reason and rationale for that?
Yeah, we also look at the outlook, Tim, and you're right. The outlook is quite negative because rising interest rates have impacted housing sentiment, resulting in a 40% decline in newly written lenders' mortgage insurance policies in the last 6 months for the company. In addition, you've got insurance claims, and that could rise as borrowers find it more difficult to pay their debt. But the company has defied market expectations, Tim, with positive earnings revisions over the last 3 months, as you can see there on Stock Doctor. And this has really been driven by two factors. The first is that with rising interest rates, there is an increase in refinancing activity as lenders aggressively compete for mortgages. So once they refinance, it allows Helia to really recognize that premium revenue earlier. And also they get cancellation fees as well on top of that. And the second factor contributing to this positive earnings revisions, Tim, is that it's through the improving returns that they generate on the investment portfolio, which mainly comprises of fixed income investments. So this income currently represents around 20% of their total earnings and is projected to increase to 30% for next year as well.
You must be very confident in the stock, Kien, because to be a borderline star growth stock, you've got to be really confident that it's going to return as a star growth stock at some stage in the future. So it's not making a lot of sense to me, but I back you in regard to your assessment of those active risks and the quality of the business. But with negative growth outlook as a borderline star growth stock, that level of confidence must be high.
Yes, Tim, even though the growth outlook is negative to us, the more important factor that we look at is the earnings revisions, which also we use as assessment for our models as well, because earnings revisions has proven to contribute more towards generating returns to shareholders over the long term. And we've backtested this over the last 20 years. Now, growth investors should aim to generate capital gains. And since inception, a year ago, the stock has generated a return of roughly around 20% for our investors, despite rising interest rates, Tim.
Yeah, okay. So I'm sure you're going to keep a really close eye on those earnings revisions then under Golden Rule 4 and obviously got down the bottom there on Golden Rule 3. So they really encourage our members to do so. Keep a close eye on this one. And I'm sure you'll act quickly, Kien, if those trends start to go the other way. But from a dividend yield perspective, they're currently sitting at 13.3% yield, which appears almost too good to be true in this environment again. So how's the company able to raise its dividend when earnings are forecast to go backwards?
Yeah, Tim, despite that negative outlook, the company was able to increase its final dividend to 14 cents per share from 12 cents per share, but they also included a special dividend of a whopping 27 cents per share. And this translates to quite an exceptional dividend yield for the half of 12.4%. So despite this, the payout ratio isn't stretched at all. It's currently at about 60%. And when you look at the company, in addition, the company plans to undertake a share buyback program of 100 million. That's roughly equating to 6% of its market cap. So it does have a lot of funds on its balance sheet to help with this. And the company could surprise investors with another special dividend for the next half.
Okay. Well, for those that really want to back this stock and believe in all of what Kien's just said and his team and the research that they've conducted to have this level of confidence in the business, for those wishing to take advantage of a really, really attractive yield at the moment, the stock goes ex-dividend on the 9th of March, so not far away. So if you're not in the stock, then you haven't got much time to take advantage of this very attractive yield. But of course, your team will continue to keep a really close eye from both that growth perspective and a yield perspective, given that it could potentially fall out of coverage next period, Kien. And now to question of the week, Kien. And with reporting season now over, and with so many star stock changes occurring, a useful question for our members is, how can I keep track of all of the changes that have occurred during reporting season if I haven't been able to be super proactive on a daily basis, Kien?
Yeah, Tim, to keep track of those star stock updates and company announcements, clients can refer to the latest star stock updates section under the research homepage. And to get more detail, click on the view all, and this will take you to the recent updates and announcements page. You can also access this page under the tools header and clicking on the recent updates tab as well. Here you'll be able to monitor star stock recommendation changes by selecting all companies, then choose a time frame, whether it's 3 months, for instance, and then select a star stock recommendation changes, and that will take you through that list as well. The tool will then provide you with all the list of star stock changes.
Yeah, it's a great tool, and I don't know if it's well utilized by members, but it's a terrific place to go if you really want, if you haven't been on top of all your stocks, but just play around with that little feature for a while, and you can drill right down into all sorts of different announcements and things apart from, just the star stock changes as well. So it's a terrific little tool. But to keep on top of changes also, Kien, you can use the alert manager to set up alerts to identify when star stock changes occur, or analyst comments update, or earnings revisions have been made. So the alert feature is also great. Of course, you can also sort by columns within the star stock watch list as well to see sort by last updated companies or when they released their last lot of results. It's also in the stock filter. And also, if you go into a company, you'll see a little arrow on the far left-hand side there where you can expand folders. And in those folders, you've got a list of all of the star stocks and when they last released as well. And right down the bottom of that little list too, you can see all of the star stocks that have been removed in the last 12 months. And you can actually drill into those very quickly and efficiently to see the full 9 golden rule screen and more, and read the analyst comments regarding the rationale for removal. But that's about it for this week again, Kien. Bumper packed. Hopefully our members really enjoyed the rich content that you and your team pull together for us each week. So thank you very much, and well done to you and your team again on a wonderful, dynamic and incredibly informative and rich reporting season that I hope our members are able to make great informed decisions from, Kien.
It's been a pleasure, Tim. And the next week, there will be a few star stock changes as well as we transition stocks from borderline to star growth, for instance, as we re-rank our models, Tim, but also the fact that we will be continuing to assess potential opportunities as well. So you might see a few stocks coming in, but also don't forget, we have the stock room on Tuesday next week, Tim, where our team of analysts, and you'll be there as well to help our members answer any questions on reporting season.
Yeah, great stuff, Kien. Thank you again. Always great sitting down, having a chat. Love it. So thank you. And of course, you would have received invitations to the stock room. Our members would have received, not just you, Kien, but our members would have received invitations via email. And of course, you can click on one of the tiles within Stock Doctor to register for the stock room next week. And of course, on Monday morning, Kien, myself, Matt Schwartz, Robbie Manfrey will be there to conduct Lincoln Live, which is the opportunity for you to come in and ask all the questions you want to, and we'll provide the answers, and maybe they're on the back of some of the content we've shared today. But to quickly summarize, Kien, before we go, we're expecting a probability of earnings revisions and downgrades to come through in the next few months. It's just a probability on the back of this rising interest rate environment. And companies are coming off really high bases, or really high levels, I should say. And so we expect to see that come off as interest rates bite, and therefore a little bit more market volatility. That's why in our managed funds, we're now positioned to around 25 to 30% cash. We're going to use that money tactically during the time we sit in cash, but move back into the market if that volatility occurs, because we expect the market to then continue on its merry way based on hopefully long-term historical averages. When I say we move to cash and we're defensive, I don't mean to spook anyone. We're just being very, very active in the way we're managing the portfolio tactically at the moment. So hopefully that helps some of our members out there make some decisions with their portfolios perhaps as well. So that's about it, Kien. Thanks again. Thanks to all our members. I hope you're all well. Can't wait to see you Monday or in the stock room next week. Take care and have a happy, healthy, prosperous week.